Good afternoon, everyone. I welcome you all for today's webinar on issues in taxation on transfer of shares through various modes. We have our distinguished speaker, Shri Pinakin Desai ji, and the session will be chaired by none other than Shri D. Manmohan ji. And with this brief round, I request our President C.A. Ramdev ji Butra for his welcome address. Over to C.A. Ramdev ji Butra.
Thank you, Ritesh. Good afternoon to all, and with a warm welcome to all of you. Particularly, I welcome our distinguished speaker, Shri Pinakin Desai sir, who has joined from Mumbai. Though through virtual mode, actually since past 2 years, we were trying to listen him in physical by inviting him in one of the seminars. But time has come now through virtual mode, at least we could able to hear him with his vast experience, knowledge and expertise. So I welcome him. I am also grateful to Shri D. Manmohan sir, who is not only our past president but has also served to a very key position and very esteemed position as Vice President of Income Tax Appellate Tribunal for a considerable time. I welcome Shri Manmohan sir and I welcome our next webinar speaker who has joined, Shri Avinash Ravani from Mumbai, will be taking our next webinar on recent changes in TDS and TCS. I welcome him also. And I welcome all the learned friends who are always keen to know more and more about different topics of taxation, accounting, and related aspects. Friends, when we were finalizing topic on to be addressed by Shri Pinakin sir, few topics we have selected and I requested him to consider. And I am thankful to him that he has consented to talk on this very vast topic. Actually, transfer of shares looks to be very small one, but it involves lot of issues, particularly when we consider capital gains. In Income Tax Act, though capital gains is the smallest chapter, but the issues involved are too high. So many judicial rulings we can find on capital gains. But transfer of shares not only relates to capital gains, but also relates to income under that business as well as other sources and various different aspects attached to the transfer and computation of income and taxation under share transfers are also very key. So I am very much delighted and honored to see two veterans who are dealing in tax matters are with us in today's webinar, and we are lucky to have them with us. I welcome you all and would like to suggest all of you who have not yet obtained membership of Tax Bar, please do so. It is the golden jubilee year. We want to cross. Already we have crossed 900 throughout AP and Telangana and other states also. People have shown keen interest to join in. I request all of you who have not yet opted to please do it. At our next webinars, before a short break, are there. Next is on 17th of October, Saturday 3 p.m. As I told you, topic is issues in TDS and TCS with respect to recent changes. Friends, as you may be knowing, lot of debate is going on regarding 2061H and other TCS and TDS provisions which have been introduced by Finance Act 2020. It will be dealt by CA Avinash Ravani sir from Mumbai. And then on 21st Wednesday, we have a meeting on topic law of evidence and burden of proof in tax matters to be dealt by Advocate Muthu Abhirami from Chennai, and simultaneously on the very same day, along with the topic, we have added one more topic, representations and pleadings, to be dealt by CA Dr. Rakesh Gupta from Delhi. So after 21st, we want to have a break till due dates are over and festival season is over. Then we will be continuing our journey for this Golden Jubilee year with new topics and great speakers like we have today. Thank you very much. I welcome you all and I request you all to keep muted till our my speaker addresses. Then in question answer you can raise your questions in chat box also. Thank you very much. Thank you, Ritesh. It is over to Ritesh.
Thank you, C.A. Ramdevji Butra, President, for your welcome address. Now I request our co-opted member, C.A. Pankaj Sancheti, to introduce our distinguished speaker, C.A. Pinakin Desai ji, and our session chairman, Shri D. Manmohan ji. Over to Pankaj.
Thank you, Ritesh. Because of the powers I'm it's a honor and privilege to session chairman for today. Both, in fact, need no introduction. They are tax legends, but we have to do it for the formality's sake. Today is Mr. Pinakin Desai. He is a member of the Institute of Accountants of India since 1973. Pinakin sir is a partner at Ernst & Young and heads its Tax Knowledge and Solutions Group. The Tax Knowledge and Solutions Group is a dedicated team of tax professionals that provides technical support to the tax practice and is engaged in developing tax solutions and strategies. Prior to joining Ernst & Young, Pinakin sir was a senior partner in PD Desai and Company and also earlier in NM Raiji and Company for 8 years. Pinakin sir was also a visiting professor in Narsi Monji College of Commerce and Education, a leading college in Mumbai. Of Bombay Chartered Accountants Society in the year 1987-88, and thereafter he has been the chairman of various committees, including International Taxation Committee and other committees. He has contributed a record of more than 30 associations, including the Indian chapters for the board of companies. Pinakin sir is also a member of the editorial board of the ICI and other committees. So, I mean, he's contributed a lot to the tax subject by way of seminars, conferences at various bodies and sessions. And we have next the session chairman for today, Mr. Manmohan Tundu. It's a pleasure for me to introduce him because I have represented before him at the tribunal. So he's completed his MCom and BL from the Andhra University, Visakhapatnam, and LLM in Environmental Studies and Human Rights, Mumbai University. He's enrolled in the State Bar Council of the Joint State of AP as an advocate in 1981 and specialized in taxation and allied laws and practiced in Hyderabad for 15 years. Thereafter, he joined the Income Tax Appellate Tribunal as a judicial various places as until 2008 when he was vice president of the ITAT and headed various zones including Chandigarh, Mumbai, Hyderabad, Chennai, Bangalore, Lucknow. Karma Yogi post his superannuation, he has revived his
sound problem
and his appears before the High Court in Telangana and Andhra Pradesh. With these brief introductions, I would request the session chairman to take over the session. Over to you, sir.
Am I audible?
Yes, sir. Yes, sir. Yes, sir.
Good morning and good evening, everybody. The topic for today's discussion, which is chosen by our tax bar association, that is Telangana and AP Tax Bar Association, it's quite interesting since it consists of a saga between genuine taxpayers planning their shares or companies for investments or issued shares under purchase and buyback scheme on the one hand, and on the other hand, of course, the department. Parallelly, there are equal number of litigants who have devised a method to introduce their undisclosed income through the circular route of investments via shell companies, or you may call it the penny stocks, purchase of shares at a nominal price and sale of the same at a very high price and claiming exemption of long-term capital gains. With regard to penny stocks and shell companies created, the Government of India had formed a committee in 2017 and that about 2 lakh companies were removed from the list. As and when a new mode of purchase and sale of shares is planned by the taxpayers, the government naturally and is equally come out with measures to plug the loopholes. And one such introduction was the introduction of Section 5627B of the Act, which was to bring to tax as income from other sources, that is to tax the difference between fair market value and the actual consideration received. The taxability of the value determined under the buyback scheme as dividend distribution tax under Section 115A, the burden of proving the source of investment under Section 68, consequent to certain judgments, that is I think iron case, I'm forgetting the name of that, apart from various provisions such as Rule 11, UA 11, UAA, 1034A, 1038, 111, 112, 12A. These goes to show that the measures taken by the legislature to bring the correct income to tax, but at the same time, the provisions concerning the transfer of shares has become more complex, leaving a genuine SEC more confused at every stage of litigation. It in fact reminds me of the Tom and Jerry cartoon story. Thanks the bump to get rid of it, it just emerges. Tom and Jerry are like taxman and the taxpayer. They are perennially at war with each other, plugging one loophole which either opens up another or leads to unintended consequences upon a genuine taxpayer. These amendments to Section 68, 115 QA, Section 112 and 112A, etc., they are all maybe with good intentions, but certainly they are paving way to many complexity. Fortunately for us, Pinakin Desai, a senior chartered accountant, is with us, and with his vast experience, he would certainly analyze the issues concerning taxation of transfer of shares quite in detail, hopefully, because he is from Bombay, and Bombay, this penny stocks and bogus share transactions cases. Of course, next to probably, because my first posting was in Calcutta, I have noticed that there are thousands of cases. When the moment I joined, people told me that don't touch these cases because most of the share companies may not be existing, but they are claiming deduction losses on the sale of shares or exemptions from the sale of shares. And Bombay also is well known for that because there are thousands of companies which have sprung up in Calcutta, Bombay, as well as in Delhi. So with his vast experience, I hope that he would dwell on this topic in the right perspective. Now I request Mr. Pinakin Desai to share his thoughts on this topic. Over to Mr. Pinakin Desai. Mr. Pinakin Desai.
Yes. Yes, sir. You're unmuted.
Yeah, respected Shri Manmohan ji, my dear friend Mr. Ravani, all the organizers of the Bar Association, a very prestigious bar with almost 900 members and celebrating the Golden Jubilee, and all those who have been able to make it to the webinar on a live basis despite very heavy rains and I'm told power outage in the area. It was only 2 or 3 days back that we had Mumbai also had the experience of a power outage, and we can understand what it means to live in a power outage, particularly in a very hot season. I also have my colleagues with me, Mr. Sneh, Mr. Sambhav, and Mr. Ramesh, who are helping me in the preparation of the slides and who also will be moving the slides for all of us. I do agree completely with the sentiments expressed by the earlier speakers that we are dealing with a topic which is a very vast topic, and frankly, we have been able to cover only some of the examples of what it may mean to deal with the issues in taxation relating to shares. But I might be disappointing you completely if I were to say that I have no experience whatever in penny stock nor in bogus transactions. So they do not today find a place in the slide deck that we have. We have transactions which are on a day-to-day basis, completely bona fide and run-of-the-mill transactions in a way, as also some of the transactions which involve restructuring. Now, with this brief background, may I commence the journey, and probably we come to the next slide, which what we have is an index of what we might like to cover here, time permitting. So to the extent we are able to go on, we will cover up. In any case, the slides will be with you for anything which is left behind. May we take up case study 1. The heading is classification of shares, characterization, whether stock in trade or as capital asset. Ever since we started practice, we have been finding on a historical basis that the issue which has survived and which has not been touched upon by the legislature is characterization of shares, how best to characterize whether I'm holding an asset as a capital asset or as a dealer or a stock in trade. A dealer will be holding an asset with the intention that he doesn't want to hold on to the asset except for maybe the profiteering and hoarding. He is out to sell the product. He would like to replace his stock on a constant basis. He does not have any belonging, no sense of belonging, no sense of devotion to any product. This may be unlike certain treasury stocks where you would believe that I should continue to hold on for a number of years. The difference between the two is that in the matter of taxation, capital gain is being taxed on a lower basis as compared to stock in trade. And the moment we find that this difference is going away, the litigation also on characterization of the asset will partly go away. While the controversy continues, over the recent years, some steps have been taken to minimize the controversy. The first is that the definition of a capital asset in section 2(14) has been amended to provide that in case of FII, all the securities will be considered to be capital asset. This is a change which is coming in through the legislation, and hence no further questions to be asked. Whatever may be the security, shares or other securities, so long as they are held by FII, they will be treated to capital gains chapter. They will always be considered to be capital asset. No questions to be asked. The classification is given by the legislature itself. But in any other case, if I need to differentiate between a capital asset and stock in trade, then I need to go over some of the factors relevant for the purpose of classification. In the next slide, we will have some indicative factors which distinguish how to determine whether an asset is in the nature of a stock in trade or is in the nature of a capital asset. While we can run over the factors, they are not very decisive factors because they are cumulative in nature, they are subjective in nature. So I would probably believe that one should also go by the smell test. The smell test being, what does it appear to you on a prima facie basis whether a person is holding on a stock as a trader or a dealer or as an investor? And I would believe the smell test, if I may repeat so, will be, dealer is a person who will be very happy to sell the stock. He is waiting for a customer to upload the stock, whereas an investor is somebody who is looking at an appreciation or who is looking at an inflow of dividend income. On this slide, there are some factors like how is the treatment given in the books of account, in the past assessments, how the stock has been taken, how do you value the securities for your books of account, what is the quantum and frequency of the transactions, period of holding of security, etc., etc. But it is very well known and well accepted that it is not as if that one assessee cannot have business portfolio and investment portfolio at the same point of time. Take, for example, a builder. His own bungalow will be considered to be in the nature of a capital asset, whereas the property which he is building and selling will be considered to be in the nature of stock in trade. Similarly, for a promoter, the securities which he is holding for his own company will undoubtedly be considered to be a capital asset, but he might also be a trader in relation to some other securities, and they might be considered to be his business portfolio. Whenever there is a conversion from a business to a capital asset or a capital asset to a business, you always find that there are complications. Capital converted to business asset, section 45 to section 2. It has been there on the statute book since the year 1988. One good thing which we have about this conversion is that if I'm holding some capital asset, which after 10 years I convert into a stock in trade, and eventually if it is sold after 10 years, then the burden of tax, whether as capital gain or as business income, will be only at the end of 20 years. At the stage of conversion, there will be some calculations to be made, but there is no levy of tax. On the other hand, if we refer to section 28, subsection Roman 6a, which has been introduced very recently, 2 or 3 years back, when there is a conversion of stock in trade into capital asset, what you find is that there is an immediate taxation on the date of conversion itself. The asset is still with you, it is not sold out, it is not encashed, and yet you find that you incur the liability. This is something which can be considered to be unfair, but that is what the law at the moment is. Now, after we had the new government, what you find is that there have been some steps taken in order to minimize the controversy. So you have two circulars in from the CBDT. They may be considered to be optional, but they are binding on the tax authority. So anybody who does not have a risk capital and who does not want to carry on litigation for years, then he may rely on this circular and try to end his litigation. Very useful circulars. February 16 says that as a benchmark, if taxpayer himself wants that some shares should be treated as stock in trade, AO will not challenge it. There are listed securities and they are held for more than 12 months. They can be offered as capital gain and AO will not challenge that. This will be applicable provided that on a consistent basis, the taxpayer will be adhering to this position. He cannot hop on and hop off in the middle of the year or from a year-to-year basis. One more circular was issued in May 16, which we may need to take with a pinch of salt. February 16 circular dealt with listed shares, whereas May 16 circular deals with unlisted shares. And we are told that gain from transfer of unlisted shares can be treated as gain by a taxpayer. But having said that, what is also mentioned is that this reasoning will not apply where shares are transferred, they carry along with them control and management of the company. On a personal basis, I would personally believe that there is a better and a stronger case that any share which carries with itself right to control and management should be all the more considered to be a capital asset, because you are very interested in holding on your control over the company. You are not a person who will be selling the shares. Articles of the association, in fact, will have very many restrictions on transfer of these shares. So the circular should have in fact said that in any case, when there is control and management, then the shares undoubtedly constitute a capital asset. But let's forget those small cases, the small number of cases. But by and large, unlisted shares, if you would like to treat that to be in the nature of a capital asset, the circular will support you completely. The next one. Now this takes us, as the next slide still, this takes us to a controversy, transfer of unquoted shares and its impact. The chairman, Shri Manmohan ji, referred to this in a brief manner. In order to test the principle, let us take an example, which is a little simple example, because what is more relevant is the principle rather than presenting the example in a complex manner. What we have is an individual, Mr. A, who is a promoter of A company private limited, and he is holding 10,000 shares of this particular company. On the liability side, we find that original capital was a lakh of rupees. Reserves have been built up at 4 lakhs of rupees. And on the asset side, 4 lakh is represented by immovable property, jewelry, and other current assets. Apart from that, the company also has a self-generated trademark or a brand, but it doesn't have any value on the books for the reason that no acquisition was incurred. It is a self-generated, it's not acquired from somebody else. Now, as a commerce man, when we look at this company, we have 3 parameters. If somebody wants to value this company on the basis of fair value of the assets, how do we look at? If somebody wants to refer to it under Rule 11 UA, to which the chairman made a reference, how do we? Book value is the accounting value known to an auditor and known to a man in business. Fair market value is that individually, if you want to sell each of the asset, how do you sell, or collectively, what valuation will you place on the asset, where you find that brand can also be valued because it has a fair value, and the per share value on the basis of the open market value is 110 rupees as against 40 rupees, which is as per the book value. Now, between the two, what we have is Rule 11 UA value, normative value, which is placed by the rule-making authority. Some of the assets alone are required to be restated by the company for the purpose of Rule 11 UA balance sheet. And this Rule 11 UA balance sheet, as on the date of transfer of a share, is required to be prepared by the company, and as per the last change made 2 years back, it is also required to be audited by the auditor of the company. One doesn't get into the true and fair value, but the audit or the certification is restricted to verify whether parameters of Rule 11UA have or have not been adhered to. Now you find in case of immobile property that the open market value is 4 lakhs of rupees, but Rule 11UA goes by the stamp duty reckoner value, and as per the reckoner, you find that the value is 5 lakhs. So what is binding is that value of 5 lakhs for restated balance sheet. Brand being self-generated, maybe it is extremely valuable, but for Rule 11UA purpose, one has to go by the books of account, no restatement is needed. Had there been an actual cost on the books, it would have been carried as Rule 11UA column, but it's not so here, so the value is nil. Jewelry, the rule is the same, carry the market value in the open market. And with this, what you get is that on a restated balance sheet, value per share is 80 rupees. So we have 3 parameters which we must remember for the next 3 or 4 slides. Book value per share is 40 rupees. Open market value is 110. Rule 11UA value is 80 per share. Having done that, what I would now suggest to you will be that forget the fair market value of 110, because for what we are going to discuss, law does not take into account the fair market value. It merely takes into account 11UA value. So we are really concerned basically, primarily, fundamentally with this value of rupees 80 per share. The next slide. Now Mr. A is holding 5,000 shares in this company and is presenting to us 2 transactions. Out of 5,000 shares, 3,000 shares sold by him to his son, Mr. B, at rupees 50 per share. Remember, book value, the cost is 40 rupees. Rule 11UA value is 80 rupees. Another transaction is 2,000 shares are gifted to Mr. X, who appears to be aged maternal uncle of Mr. X. He is a non-relative. He sold to Mr. B, his son, who is a relative. He is gifting to Mr. X, who is a non-relative. We will consider each of the 2 transactions in the 2 slides to follow and try to look at how Mr. A will be taxed on the sale transaction, how Mr. A will be taxed on the gift transaction of 2,000 shares. We come to the transaction 3,000 shares sold to relative son for rupees 50 per share. Shares are sold, we have to compute the capital gain income. In computing capital gain income, the rule that we have today is under section 50 capital CA, to which this chairman made a reference in his opening remark, that if I am Mr. A and I sell the shares to my son for a consideration which is lower than Rule 11UA value, then in computing the capital gain income, Rule 11UA value will be substituted as if actual consideration which I received is rupees 80 per share, being Rule 11UA value. If I had sold the shares at a value above rupees 80 per share, then whatever is the sale price as per the document of sale would be taken. But if I am selling at lower than this, then while I might have realized lower amount, capital gain will be computed as if I have recovered sale consideration at the rate of rupees 80 per share. 3,000 shares have been sold out. I sold at rupees 50 per share. I realized 1,50,000. However, law will tell me under section 50 CA that begin your computation capital gain as if your sale consideration is rupees 80 per share, that is 2,40,000. Now a point to remember here is that despite the fact that shares have been sold to own son, a relative, a close relative, a kith and kin, section 50 CA does not have any relaxation. When you come to the recipient, Mr. A, the relative, you will find that different rules are prevailing. We will take it up in a minute. But for computing the capital gain, you will compute capital gain on the basis of rupees 80 per share, despite the fact that the sale is to a relative. Incidentally, section 50 CA applies in relation to the unquoted shares. Had it been a case of listed shares, then section 50 CA would not have been operative. Now come to the case of the son who is receiving the shares. He has paid rupees 50 per share, whereas what he has received is a share which is worth rupees 80. Whatever might be the market worth, let us remember we are not concerned. For the purpose of section 56 into bracket 210, which taxes a recipient of a gift, taxes a recipient of somebody who acquires an asset at lower than Rule 11 UA value, what you find is that if the receipt is from a relative, the section does not apply. So, son will not pay any tax. He paid 1,50,000, but he will not pay any further tax at all. Transferor has paid the tax and son has not paid the tax. So this is one way of looking at case study 2. Let us now look at this second transaction. This is a transaction, if you recall, is 2 shares have been gifted by Mr. A, but the gift is in favor of non-relative. How do you treat the transferor and how do you treat the transferee is the question. Section 50 CA may be relevant in case of the transferor. We will no doubt need to interpret section 50 CA. But before we come to section 50 CA, which is in the nature of a computation provision, we will first need to address the charging provision. Charging provision is section 45 in case of capital gain chapter. But in section 47, we have some transactions where we are told that some of the transfers, and gift is a transfer, some of the transfers, though they might be transfers under the Transfer of Property Act, will be considered to be transfers for the purposes of the Capital Gains chapter of Income Tax Act. You ignore as if a transfer has taken place for the limited purpose of capital gains chapter in the hands of the transferor. One of the exemptions is section 47 Roman 3, which is a transaction of a gift by one person to another. There is a transfer by Mr. A to anybody. So long as it is a gift, what you find is that for capital gains chapter, read with section 45, charge is not attracted. Question of computing the capital gain does not arise. So you will tell Mr. A that yes, bona fide gift given. There is nothing to doubt here. Old aged maternal uncle, maybe he was starving. Out of good wishes, gift has been given, and therefore there is no capital gain, no consideration received. Even under section 50 capital CA, you will arrive at the same result on interpretation. What section 50 CS says is that if there is a consideration received or accruing, and if it is lower than Rule 11 value, some consequences will follow. So implicit in the applicable section is that there is a consideration which is received or accruing. If no consideration has accrued at all, then the start point of the section does not trigger. And even if therefore section 50 CA is erroneously attracted or interpreted, one would probably come to the same conclusion. So no capital gains so far as the transferor is concerned. In the hands of Mr. X, who is recipient of a gift, how do we look at the transaction? Normally, before 10 years, such a transaction would have been tax-free. But what we are now told is that if there is a receipt of any property, including share in a company, it has to be a specified property, and share is one of the specified property. Then, in relation to a gift, Rule 11 UA value will be considered to be deemed income earned by Mr. X in the computation of his income. X will be taxed at the rate of rupees 80, 2,000 shares, 1,60,000. This would be income from other sources because section 56 to 10 falls within the head income from other sources. Now, since one is taxing Mr. X in respect of the gift, there is a corresponding cost step-up which is given, namely that Mr. X will also be deemed to have acquired the share at a cost of rupees 1,60,000. So tomorrow when he sells the shares, he will be able to claim 1,60,000 as his cost of acquisition. In the traditional days, whenever there is a gift which is received, under section 49, cost of acquisition in the hands of the predecessor alone would have been granted as cost of acquisition to the donee. In a case where a gift has been brought to tax, what we find is that there is a backup provision for substituting the cost of acquisition. The next one. Now this brings us to our next scenario, where all the illustrations which we take up here are the illustrations where what you find is that the new or fresh shares are coming into existence. And why are we taking this up? What we want to test is section 56 to 10. In section 56 to 10, what we are told is that if there is a receipt of share, receipt of specified property, share is one of the specified property. So what I'm saying is, if there is receipt of share by one person from another, then certain consequences may follow. But what we need to be careful in observing is, there is receipt by one Mr. A from another Mr. B, one Mr. X from another Mr. Y. Receipt is the other side or the other point of a transfer. So what we are trying to say is that if Mr. A transfers his property to Mr. B, there is a transfer of property by one person to another. Mr. B will in such a case say that he is as one person receiving the property for another. Why we are repeating this is to ascertain a very important principle which is of relevance in interpretation of section 56 to 10. when can Mr. A transfer a property to Mr. B? Implicit in suggesting that there is a transfer of property by Mr. A to Mr. B, what we are without noticing concluding is that there is already some existing property which is today already held by Mr. A. Even without Mr. B being on the scene, property is existing. Mr. A is the owner of the property. And now Mr. A passes on or transferring that property to Mr. B. So Mr. A ceases to be the owner of the property and Mr. B becomes the owner of the property. Looked at alternatively, for the purpose of 56 to 10, Mr. B is in receipt of a property. It was an already existing share or a specified property in the hands of Mr. A, and Mr. B is now in receipt of that property from Mr. A. Now with this background, now Shri, if you could turn to the preceding slide, the earlier one. What we have next are, there is a family company. Mr. A and Mr. B are already holding certain shares. There needs to be some family separation. We are told is a cousin of Mr. A. Maybe the generations are separating. Uncle is separating from father. In a family arrangement document, it is decided that control of this ACO should go to A's family or A branch of the family. So there is an understanding that there will be a rights issue of shares. It is at face value. Rule 11 UA value may be very high. And as a result of new shares which are acquired by Mr. from the company, shares acquired in the sense shares allotted by the company to Mr. A, Mr. A receives certain further shares. Because of the family arrangement document, Mr. B does not subscribe to the shares. Now let me clarify one thing, that we will first examine the issue without the impact of family arrangement document, and we will thereafter examine it with the impact of family arrangement document. To my mind, answer would be the same. Family arrangement document, to my mind, is an additional argument, and therefore I should not be misunderstood as saying that the conclusion which I have in my view is influenced by the family arrangement document. I think principle would have been the same even without there being a family arrangement document. But with a small difference, that if something was to be done by virtue of a GAR-prone transaction or a tax avoidant transaction, then different result may follow. At the moment we are examining a transaction which is fair and bona fide. Here it should not make a difference whether it is under or without a family arrangement. So the next slide now. So we are now examining whether Mr. A will be subjected to any tax under section 56 to 10 on the ground that he has received additional shares as an LOT from the company. Question is, has the company transferred the shares to Mr. A? Is it a case where property was already existing in the hands of the company and is now being transferred to Mr. A? The correct answer, followed by a number of Supreme Court decisions, one of them has been cited here, has been that a share is a chose in action. It is created by virtue of an allotment. It was not an existing property at all. in the hands of the company. We examine the principle as to when we believe that 56(2)(10) can apply, and going by that principle of there being no existing property, my view in this particular case will be that on a fresh issue of shares, section 56(2)(10) will not be applied. Interestingly, you will find in 2011, the board issued a circular confirming what I am saying here, and that circular has still not been withdrawn. It is there and it is binding on the CBDT. Without noticing the earlier circular, in 2018, again a circular was issued. That circular was more specific to say that purpose of 56(2)(10), fresh issue will not apply. It was immediately thereafter withdrawn on account of a political debate which it had generated, as we all know. But that, I think, should not make a difference. 2011 circular on principles says the same thing which 2018 wanted to say. And in any case, my reliance is on the Supreme Court judgment and language of the section and not on the circular. The next slide. Family arrangement is an additional argument. Whenever on capital gain chapter or on 56(2)(10), we have a number of decisions, including of the Supreme Court, where sanctity of a bona fide family arrangement has been upheld by the courts. In particular, Mumbai Tribunal, specifically with reference to 56(2)(7), which is the corresponding predecessor to 56(2)(10), has upheld the sanctity of a family arrangement deed. So combine this argument as well, and I would believe that Mr. A should not be liable to tax under section 56(2)(10) in the facts of the case. Next. We now take up a relatively small issue, which is a very fair and equitable interpretation we are trying to put upon the provision. This is a company where there are 1 crore shares in the company, each share of 10 rupees each. So 10 crore is the equity share capital of the company. 70 crore of the reserves have been built up, and we find 80 crore is the net worth of the company. Per share, Rule 11 value would have been rupees 80 per share for any reorganization. What this company does is to allot bonus shares. 1:1 bonus is allotted. Capital now becomes 2 crore shares, 20 crore, paid face value. So the existing shareholder who had 1 crore share is receiving another 1 crore share. He receives bonus share without contributing anything to the company, as it appears in terms of a bank transaction. Question is, can the officer say that you are in receipt of 1 crore shares, nothing has been paid by you, and since nothing is paid, difference between Rule 11 UA value, which after the bonus issue drops down to 40 rupees, will be considered to be in the nature of gain taxable under the head income from other sources. Suddenly you become very rich, as it appears, without having paid anything to the company, which is how a layman will look at the proposition. Now, there are 3 different reasons why we would believe that the shareholder who receives the shares from the company as bonus shares cannot at all be subjected to this tax, apart from it being fair and equitable. The first is, this is a fresh issue of shares, not an existing property being received by him. Therefore, the section should not apply. Second, way back the Supreme Court in various decisions said that person is receiving a bonus share or a right share, it is not as if that he does not give any consideration, he does not invest anything in the shares of a company. What he does is that the difference in the fair value of shares just prior to the date of event as compared to the actual amount which is being paid is indirectly the cost which is invested by him. So what you find here is that in respect of your existing 1 crore share, X bonus on the market, the value will become half. You are losing on your original holding in order to gain or compensate in your new holding, amount which has been invested in the form of diminution of the value of the original holding will be deemed to have been amount invested. So 56:10 tells us that there can be incremental income provided that I receive the shares without there being a backup consideration. If I have paid almost equivalent to the fair value of the share, there is no question of enrichment on my part. So on 56:10, I, on my own part, will feel quite comfortable. There is also a tribunal decision to that effect, which has been cited here. But what you will find here, and that's what we are going to use in some later slide, is that the principle which we have applied here for determining section 56:10 taxability in the hands of the shareholder in relation to the bonus share will not be applicable in his hands for the purpose of eventually computing the capital gain income. He will be selling the bonus shares. For capital gains purposes, whenever the gentleman would be selling the shares, whether original shares or bonus shares, the rules to apply will be different. We have taken into consideration diminishing value to be the amount invested for the purpose of 56:10 because of the commercial principles which apply in the interpretation of 56:10. But when the law tells you more specifically that for capital gain chapter some different principle has to apply, then we will tell Mr. A that when you sell the bonus shares in the market tomorrow, for computing capital gain income, your acquisition will be considered to be nil under section 55 subsection 2 of ITA, and by virtue of the same provision, your cost of acquisition of the original shares will be preserved without there being a dilution. So this is what we will be using in some examples that we read in the slides to follow. Next one. Now this is a small principle where again we are dealing with the fresh issue of shares, not an existing property, property being a chosen action being created. There is a listed company, and that listed company establishes an employee welfare trust, and it also establishes an ESOP trust where certain of the shares are allotted to the trust and through the trust to the employees by way of the ESOP plan. Will be the shares to be received by the employees eventually, allotted by the company. employee may be given the shares maybe only at a face value, while the ruling value is very high. Either unlisted company can do it or listed company can do it. Doesn't make any difference to the principle which we are examining. Now, can an employee be told that the employee should pay tax under section 56(2)(10) on the shares which he receives if he acquires the shares at a face value, where, say for example, the market value of the share is say 1,000 rupees per share, whereas you get it only for rupees 10 per share. Now what you should combine here for backing up or reaffirming the conclusion is, one of course is no existing property, therefore 56(2)(10) doesn't apply. But in addition, we must remember that this is a transaction which will be taxed under the salary chapter in the hands of the employee. Employee will pay full tax on difference between the market value minus the 10 rupees which he contributes to the company, and having already taxed it as salary income, which is a more specific section, you can't tax it over again under section 56(2)(10). In fact, had he been taxed under section 56(2)(10), he would have been taxed only with reference to Rule 11 UA value in case of unlisted company, whereas under the ESOP provision salary chapter, he is amenable to tax with reference to the full market value of the property, even if it is multiple times higher than Rule 11 UA value. We are also aware of the principle that the residual head of income, income from other sources, will apply in a case where no other head of income is applicable, and hence also we would believe more appropriate head of taxation was the salary head and not income from other sources. The next one. We go to the next question. Now, this is a principle where there could be unfair taxation, and we are trying to examine whether there is any defense against such an unfair taxation. Mr. A is a shareholder along with Mr. B of a company which is in the mining sector. A wants to retire from the company and the Mr. B, they carry out the valuation and they believe that ₹1 share is the correct value of the share. Valuation done by the chartered accountants, merchant banker, and there is no dispute that valuation. Regulatory approval for the purpose of approving the transaction, and it takes supposing 6 months' time for the regulator to pass it. In the meanwhile, Mr. B might have also deposited the amount in escrow account and is ready to fulfill his part of the transaction. Some of the voting rights might also have shifted in favor of Mr. B while he can't vote, but it might be said that Mr. A will cooperate with Mr. B for the purpose of voting, etc. Now, since the company has been doing good, by the time after 6 months the shares are getting formally transferred, the market value of the share is supposing 150 rupees. Now the question is, under section 50 CA, will Mr. A pay tax with reference to 150 rupees, which is the Rule 11 UA value, on the actual date of signing of the transfer form, or will he pay tax on 120 rupees that he actually receives and which was the fair value, fair Rule 11 UA value even as on the date on which agreement was made, binding agreement, specific performance can be enforced upon parties wanting to implement the transaction. Regulator also has seen the price and has approved the transaction. So the next slide will tell us, should Mr. A be taxed on rupees 150 or on 120 rupees? And this slide before your eyes, in the hands of Mr. B, the acquirer or the transferee, section 56(2)(10, does he acquire shares having rule 11 UA value of 150 by paying only 120 rupees? Should one be taxed 30 rupees because he is buying cheap and another because he is selling cheap? Yes, both could be possible in an appropriate scenario, but in what we discuss, is this a fair or a right taxation? How can the acquirer, Mr. B, argue his matter if he is before Manmohan ji, the tribunal? What I would believe is that section 56(2)(10, and this has been done by the tribunal in a number of cases, they have always, while interpreting 56(2)(10, often referred to the object behind introducing section 56(2)(10, that it's a action brought about to take charge of the money laundering transaction. So if there are bond cases, then you need to be careful before you apply the provision. Second is, the purchaser is being taxed under 56(2)(10 on the basis that he is acquiring a property by paying a lower price. Now, what is the property that he is acquiring? Can Mr. B, the acquirer, say that the day on which he signs an agreement, he has acquired some interest in the property, right to specific performance as well to the property. He has a right to appreciation in the property from that day onwards. So the incremental value which he derives is not what he derives from Mr. A. He is only working upon an agreement which is already existing in his hand. He acquires what belongs to him right of the agreement, and he is not getting enriched by something belonging to Mr. A, which is being sacrificed in favor of Mr. B. Look at alternatively, actually what is the sacrifice which Mr. B suffer? He pays rupees 120 to Mr. A. In addition, there is a termination of his interest in an agreement to acquire the property, because now there is a formal acquisition. That agreement was worth rupees 30. If during the intervening period he had already transferred that agreement right to somebody, that somebody would have paid 30 rupees to Mr. B, which is now being terminated by him. So what is suffers by way of consideration is ostensible payment of 120 plus extinguishment of a right which existing up to that date in the form of incremental value of the agreement, and that is why he has paid the right price of 150 to Mr. A. This is subject to litigation. I would personally believe that the transferee has a much better case to urge that 56(2)(10 is not attractive. The next one. Examine now in the hands of the transferor. And in the hands of the transferor, you tax him under section 50CA with reference to the full value. And I would probably here rely on the Supreme Court decision in Varghese case, where Supreme Court in fact examined the virus of section 52, subsection 2, but it did not conclude on the virus. In the course of the dispensation, it dealt with a number of other principles which may be of relevance here. Supreme Court picked up an example, and this is what the Supreme Court says, not me. It picks up the example in the context of an immovable property that one person wants to sell property at the correct price. In the intervening period, if the prices have risen, but the persons are obedient to law, and being obedient to law, they honor the agreement which they have transferred. Can you tax a person because he is obedient of law? Can one law which requires him to obey the law and honor the transaction, can there also be another law where a person will be punished because he has obeyed the law? And having said that, the Supreme Court said that in situations like this, when what you find is that you are arriving at an unfair and an inequitable reason, what you will do, you can do violence to the language of the law. And having done violence to the language, you can determine the tax consequences. Now, how do I look at the violence in this particular case? And for doing this violence, I will rely on Section 50CA itself. Inbuilt in Section 50CA is what we have, an explanation added in relation to immovable property. It's an explanation added for immovable property, but I would personally feel it's an explanation added in order to make the law bearable and equitable and fair. Only the immovable property was available in Section 50C. At that point of time, 50CA was not available, but the inequity which applies to Section 50C for immovable property applies also to Section 50CA, applies also to Section 56 to 10. You find provisions in 50C and 56 to 10 that value as on the date of signing of the agreement is more relevant. There are tribunal decisions which have taken a view that even without the explanation having been inserted in those sections, interpretation of those sections would have been the same. Namely, along the line of KP Varghese case, go by the circumstances which are relevant on the date of agreement, and if you find something fair and equitable on the date of agreement, don't subject a person to tax again. On this combined reasoning, I would personally feel there is a good case to defend the liability, though I must admit this is likely to be subject to litigation. We then move to the next case study, and the next slide that we have tells us some of the facts. Next slide, please. Person had 100 shares with him. He acquired those shares in 1995, and he acquired for cost of 1,000 rupees per share. April 2001, fair value of is 1,500 per share. This is relevant because in computing cost of acquisition for capital gain purposes, our share cost, anything acquired before 2001, at the option of the taxpayer, the cost of 1,500, that is the fair value in 2001, can be taken. There were only 100 shares in 2001, and market value will be relevant only for those 100 shares. Bonus shares have been issued thereafter over a period. 1,000 bonus shares issued over a period. None of them was existing in 2001. Everything is after 2001. In relation to bonus share, you can't fall back on the market value on 1st April 2001. Had bonus been acquired before 1st April 2001, it would have been relevant to fall back on the market value of April 2001, but the shares acquired after 2001, so the concept of 2001 is not relevant. Total shares 1100. 31st January 2018, value of the share is 300. That is the date of grandfathering of the value when the capital gain exemption was given up and the listed shares capital gain became taxable. Eventually, in September 2020, all the shares, original and bonus shares, are sold. One scenario sold for 350 rupees, another scenario sold for 200 rupees. Now, let us look at how I compute the capital gain in the hands of Mr. A for original shares and for bonus shares. Let's presume that the conditions of section 112A are all fulfilled, and we come to the next slide, which shows the computation. The next one still. Next one. Next slide. Now, here we have the computation. You find the particulars, you find original shares, you find bonus shares. Principles to apply will be different for original shares slightly as compared to bonus share. That is why two different columns here. What we are trying to find out, let us recollect, is shares are sold for 350 rupees. In computing the capital gain in the hands of this gentleman, what would be the deductible cost of acquisition to be compared with the sale value of 350 rupees. So this slide is meant for computing the cost of acquisition deductible against rupees 350 of the sale value, keeping in view section 55 to AC and section 112A. The principle a bit complicated, but if we do stepwise, it's not so complicated. Refer to the particular. How do I determine the cost? First principle, higher of the two, and immediately thereafter what we find? Cost of acquisition of shares. That is, what would have been the traditional cost of acquisition of shares under the ordinary law. If this specification was not applicable, and if somebody had to work out the traditional cost of acquisition without indexation, what would be his cost? And my answer would be, for 100 original shares, the fair market value 2001, so 1500 per share. We just discussed why fair market value is to be taken. For the column of bonus shares, value would be nil. I can't take 2001 value because bonus shares are allotted after 2001. So we have worked out one step, cost of acquisition, traditional cost of acquisition. Come to the next step, which is arithmetic. You have to find out lower of fair market value on 31st January 18. It is 300 rupees in the inner column. It is 300 for bonus share as also for the original share, because the market does not make any distinction. They are pari passu shares. Full value consideration received is 350 rupees. All have been sold for the same value, 350 rupees. Having done the steps, now we rerun and let us see. I have to work out higher of Roman 1 and Roman 2. But before I do that, within Roman 2, I have to work out lower of fair market value, January 18, and value of consideration received. So I first go to Roman 2. The lower of the two is 300 rupees in original section as also in the bonus section. Then higher of Roman 1 and Roman 2. Higher of 1500, which is Roman 1 for original share, and 300, so higher is 1500. But when I come to shares, the higher of the two is 300, so my cost will be 300. So capital gain will be computed. I will say for original share, money received 350 rupees, cost is 1500, and therefore there is capital loss which I have incurred of 1150, expenditure on transfer 1155. On bonus share, 350 rupees has been sold, and what I find is that this, not this, I think this is not the correct slide. No, earlier to this, yes. No, please, next and wait. No, earlier to this. Earlier to this. No, where you are giving bonus shares of 300. Okay, correct. This is the one. Don't worry, let this slide be here. So 350 rupees is the sale value derived. Deductible cost of original shares is 1500, and therefore there is a capital loss in this section. 350 bonus shares are sold. Cost of bonus shares is 300, which is deductible as per the formula, and therefore the capital gain will be 50 rupees only. Normally, capital gain would have been with reference to nil value, but because of the grandfathering of 31st January 2018, you pay tax only on 50 rupees. Now let's look at the next working, which is where shares are sold for 200. Parallel working. The steps, original shares, higher of the two, Roman 1 1500, Roman 2 fair value 300, drop down 200, lower of the two is 200. So higher of the two for original share is still 1500. There is no change at all. So in the original share section, sold for 200, deductible cost is 1500. Your capital loss will be 1300. In the bonus section, you find a difference. You sold the shares for 200. Your deductible cost will also be 200. When you sold the shares for 350, deductible cost was 300. But when you sell the shares for 200, your deductible cost is now 200 and your capital gain is nil. What is happening here is that if you were given the deductible cost of 300, you would have incurred capital loss on the bonus section as well. But what we are told is that if loss is accruing or arising because of the fair value grandfathering, such a loss will not be taken into account. As a result of that, your calculation will be restricted to nil. Now with this, we go to the next case study. I think probably the last one which we will be able to take up today. But the slides are there with the participants for any further referencing that they need. And this which is normal because typically our speaker will keep a slide or two extra to deal with the contingency of some last minute amendment in law coming in as a surprise. and some subject becoming redundant. So we take up this as the last case study today. Buyback of shares of a listed company. We have a next slide, please. We have a slide here where a company had allotted over the life of the company 20,000 shares. 10,000 allotted in 2002. Company received 10 rupees as issue price. In 2008, another 10,000. Company did well. It received 100 rupees of the issue price. So if you go by the sequence of the transaction, earlier lot allotted for company received 10 rupees. Later lot company received 100 rupees. First in, first out basis, company received 10 rupees and thereafter company received 100 rupees. These shares might be traded on the exchange and market. Somebody may pay 1,000 rupees, value may drop down to 300, 700. We are not concerned as a company. The only parameter which get fixed for the company is that company when it allotted got 10 rupees, rupees. Trading in the market does not change the book value or the book results of the company in any case. Now 25% of the shares of this company are bought back by the company. What happens in a buyback is company will make an offer to the people that if you want to give the shares back to the company, company will receive them, but the company will immediately cancel them. Company has no use of the share. Company has to cancel under the Companies Act. The shares will be of no value to the company. Company receives just a piece of paper if at all, and in a demat regime, company does not even receive that. Now there is one Mr. A who had acquired 1,000 shares. He is one of the shareholders who gave the shares back to the company. Total 5,000 shares received back by the company. Company has paid at the rate of rupees 450 per share. For every share coming in back to the company, 450 rupees distributed by the company, whereas company had received on a FIFO basis 10 rupees. And if we go by the sequence, maybe 100 rupees as well for the later lot. Now, if you look at the next slide, you will find the buyback tax liability of the company. Whenever there is a buyback taking place, Section 115Q tells us that company is subject to the buyback tax. Tax on what? Tax on income. The income, legislature says that distributed income. If you distribute more, you earn more income is the philosophy by which this tax is being levied. As you pay, you gain is the philosophy on which this tax is being levied. Company is told that you work out total amount which you have paid to the shareholder, minus out what you had originally received from the shareholders at the time. The difference is your distributed income. So on this 5,000, you distributed something, find out what you got is 5,000 shares. Since company cannot identify and no listed company can identify which shares have come back, we are told in Rule 40BB that on a FIFO basis, the shares should be deemed to have been bought back by the company. So if you go back to the earlier slide, on a FIFO basis, 5,000 out of the first lot of 10,000 shares issued at rupees 10 will be deemed to have been bought back by the company. Next slide now will therefore show us the working. Next. next, and then next. Slide 33. At the rate of 450, amount is distributed. At the rate of 10, amount is received. 440 per share is the distributed income. And on that, there is buyback tax liability at a given rate. So this is what the company will pay by way of buyback tax. Now illustratively look at the shareholder, Mr. A. The next slide will now tell you how Mr. A will look at it. He in fact bought the shares at 500 rupees. He has incurred capital loss by himself, and yet he finds that company has to pay a very heavy tax. Ultimately, the burden will be on the shareholders. But what we are told on a buyback is that company having paid the tax, the shareholder will find himself exempted from all taxation, nothing payable by the company. When there is an exempt income, loss in that stream of income is also to be exempted. Income is a neutral term, profit or loss. If section 10, subsection 34 capital A exempts the income in the hands of the shareholder, you find that there is no loss which is admissible in the hands of the shareholder. So while the company would pay tax, nobody else would pay the tax. Company pays the tax on a FIFO basis by virtue of a fiction, and application might show something different, but on a demat transaction, you don't have an identification possible. So far as company is concerned, there is only one demat account. You go by a FIFO line. Had it been a traditional law in the hands of the shareholder, somebody could have tried different demat account and different tax results. But with the buyback tax coming in, which now applies to listed as also unlisted company, you find that it has been a game changer. Now, I'm aware, all my friends, that the topic has been a very, very vast topic. And even if we had run through all the slides, it cannot cover more than 20-30% of what the issues which normally occur in a year on the desk of any chartered accountant. So probably, I think a more prudent way will be that in your series of webinars, you may continue with this subject, and maybe some good friend of ours might be able to deal with extra issues which I have not been able to take up or contemplate upon. May I, with this, maybe express my gratitude to the organizers having given this opportunity. It has been a good help for me to brush up myself. It keeps me going on a running basis, but help me out to get updated on what the current scenario on this topic says. I'm sorry that we are dealing with this on a day where your attendance has been a little poor due to the weather conditions, but I'm happy that you have this running up on the YouTube, and I would be too happy if this is of some use to many others in your organization as well. Thank you so very much.
Thank you so much,
Chair.
Pinakin Desai. So we can move toward the question answer section. If there are any questions, the request to put it in the chat box.
There is a request for sharing of the PPT. Yes, it could be done. It would be there on YouTube, I suppose. So my request to the organizers was not to distribute prior to the presentation. There is nothing secret about it. You may please distribute, no issues.
Yes.
Ritesh, take up question.
Yeah, I think we may not have very high time for questions,
Yes, sir.
answers, but I did mention to the uh, president that maybe if there are any unanswered questions, we would be willing to come back to you. If not on the chat box, maybe on a mail. Yeah.
Sure.
Yes.
Thank you very much.
Thank you, sir.
Mr. Devdas wants to ask some question. Like Mr. David wanted to ask some question. One or
Yeah.
two questions.
Correct. Yeah. Sir,
Mr. Pinakin, how are you? Devdas here.
had it been received on inheritance or gift, which is what the question is, then on while dealing with section 56 to 10 and uncle receiving the gift, maternal uncle, we did touch upon it, namely that when there is a gift receipt, earlier period there was no taxation in the hands of the recipient at all, but in the hands of the recipient of a gift, cost of acquisition would have been the cost of the predecessor and not the cost or not the market value as on the date of the gift. After introduction of section 6 to 10, in a case where person has been subjected to tax under section 56 to 10, the rule 11 UA value will become the cost of acquisition for eventual capital gain liability of the donee. But if for some reason section 56 to 10 cannot be invoked in the case of the recipient because he happens to be a relative receiving the shares, then the same old law will continue, namely the preceding cost of acquisition in the hands of the transferor will in a gift be the cost of the acquirer. So far as inheritance is concerned, section 56 to 10 does not apply at all. And therefore, the only rule which is applicable is that cost in the hands of the recipient will be the cost of the predecessor.
Yes.
We recognize the presence of our past president, K.C. Devidas.
Manmohan's.
Yes, sir. Now I request our session chairman, Shri Manmohan ji, for his closing remarks.
Thank you very much. Thank you, Mr. Pinakin Desai, for having wonderfully covered the issues. As you rightly put it, this subject is so vast that it's impossible to cover in one session. We require 2 or 3 sessions. The limitations, despite heavy rains, but it's wonderful. It's only because of the importance to the topic as well as the knowledge that people have expectations that you definitely share with regard to this subject. Of course, we have covered on the topic of Rule 11.2a and a wonderful example that you have given with regard to Section 50 CA and 56.210 as to what would be the case if at all at the time of agreement there is a particular price, but at the time of ultimate sale there is a different price. Yes, these are the issues which had to be decided at a right forum, but these are wonderful issues that you have raised. These are brainstorming. We thank you very much for having spared your time on this occasion. And now over to Mr. Bhuttaraji, President. Yes.
Thank you, Manmohan sir. Before informally I convey my gratitude to great personalities who have joined today. Sir, 75% of Hyderabad is affected severely, but we could secure 50% of our expected attendance at least today. Actually, at one point of time, many people called and told that they are not having net connectivity, even power outage is there. So we were worried. In fact, before commencement of the session, I had a chat with Pinakin sir. He was also expressing his apprehensions. What would be the situation? Then I requested him, sir, I am confident that session will run smoothly there without any interruptions due to power failure also. So thank God, I must pray to God, and also I thank God that we could finish the session. This session was not meant for short discussion, but it was long discussion. Anyhow, subject is so vast, we couldn't cover entire thing. There are so many typical situations, case to case, they may arise in practical aspects. So for taking each illustration individually is very difficult to cover in a webinar or a one session. So we expect Pinakin sir would consent for future our deliberations also on the topic whenever he deems fit. So I expect him his blessings will continue with us. So with this brief, I hand over to Ritesh with thanking both Pinakin sir and Manmohan sir for blessing us today. Over to Ritesh.
Thank you, sir. And we thank the speaker, our session chairman, for taking a wonderful session. And now for a formal vote of thanks, I request our GC member, CAK Hanmanlu, to propose a vote of thanks. Over to K. Hanmanlu.
Am I audible, sir?
Yes, sir.
Sir, knowledge or information about transfer of shares and taxes effect thereon, capital gains. We extend warm thanks to today's chairman, Shri Manmohan Garu, past vice president, ITAT, Income Tax Appellate Tribunal, and the speaker, CA Pinakin Desai, sir. And next speaker for the next session, Avinash Ravaniji, and president and GC members, participants, Sambamur sir for big support, participants from other places, and also members participating from Federation of Telangana Chamber of Commerce and Industry, and all participants. Thanks to all joining and making this webinar successful. Thank you to all. Over to Ritesh.
Thank you so much. So with this, we come to end of the session. Thank you one and all for attending the session. Thank you one and all. Please be joined for the next programs. Thank you so much.
Thank you for all the